Howdy, Jacob here. Today we'll be going over the next company on our dividend yield screener. Today's company is Best Buy. I feel like this will be a company that many have heard of, pretty popular in the technology retail space. They're in the specialty retail industry. Um, I don't even know why I have to say that. I feel like pretty much everyone knows Best Buy, but let's go over preliminary numbers. So 14.5 market cap, 14.7 essentially enterprise value. So not a lot of net debt. That's great to see. 11 PE looks pretty cheap from that metric. Huge return on invested capital. Not as high return on invested asset, but great return on the money that they invest through capital investments. Let's see. So they've been buying back shares pretty heavily. Cash paid for dividends. Let's see what their payout ratio is. About 800 right now, and they make, let's see, 1900 or 1.9 billion there, 900 million there. So it looks like just 2023 was pretty low, but even then, their payout wasn't full. Um, I mean, if there was consistently that would be a pretty high ratio. But if it's closer to the 2 bill or 1.5 billion to 2 billion for a company as well known and as stable as Best Buy, I feel like a roughly 50% payout shouldn't be too bad. All right, let's get to making some assumptions here. So Best Buy in the retail space, I think they could easily. I don't know. It feel like to me it's slightly declining without reinvesting back into themselves and without inflation. So I might do maybe one or two. Let's try two on the revenue change side. Um, I mean, they have a lot of money. They have a high ROIC, but again, return on invested capital doesn't mean as much if they never use it. I'm not saying they never use it. If they have the possibility to do so, I feel like they would, but they're paying out a pretty hefty sum on dividends and then buying back the rest of the shares with their capital. So there's not going to be a lot of reinvesting, I feel like, at these percentages. And if there is, it's going to be a small percent of their cash from operations anyways. So maybe a 13p. I don't. It shouldn't deserve too much of a premium just because, although their ROC is very high, I just don't see them using it as such. Since they're using so much cash for dividends and buyback shares, which nothing wrong with that. But um, then the terminal P doesn't necessarily deserve a premium. Let's see what's up here. About 3 to 5, 4 or 5. I like that the cash flow is consistently higher. What do we say? Debt was pretty low, 1.1 in long-term debt, which is less than a year's worth. I mean, that's pretty great. So higher interest rates shouldn't affect them nearly as much as most other companies. I feel like their biggest threat is just going to be keeping up with the online retailers that just have less fixed costs. So let's see. I feel like conservatively we could say maybe like three. Let's do like 3.2 and like 3.5 maybe. That's pretty conservative. They've been buying back shares pretty consistently. Let's say -3. So with these assumptions and for the dividend assumption, we're assuming that it stays flat, even though they've consistently increased it. Man, I might increase this. So let's increase it at 4%. So basically, they're increasing it with inflation. They're 7 years from now is at $4.66. The earnings per share since 2019 has consistently been higher than that. That's a pretty fair assumption, I think. So, given all of these assumptions, we're looking at nearly 15% return. We're saying that it would have to decline roughly 7% more to get to the 63.3 price, which should yield a 15% discount rate. I feel like this is a company I might soon do another video on just to get a little deeper, since these high level videos are just meant to see if it's even worth doing a further deep dive. But as of now, it looks like it's pretty close from with again these assumptions. So I hope everyone reviews this company and puts in their own assumptions, and then compares it against mine. We can see how you compare what your price looks like to get 15% return or whatever discount rate you require. Because again, my situation is going to be different than anyone else's, and so with that, I hope everyone has a good rest of their day. Thank you so much.